Hey everyone. This is Adrian here from the Black Card Red Spade podcast. Today I have my friend and special guest, Kris Sidial, who is the head of the Ambrus Group. He's the co-CIO. Kris and I have known one another for over a year now. I interviewed him about a year ago. I think it was September 2020, if I recall correctly.
Yeah.
And yeah, we've chatted for quite a while. I've learned a lot from Kris. He's also good friends with my co-host Jamie. And Jamie, between Jamie and Kris, I've learned so much about volatility and options trading. These guys have essentially forgotten all the things that I still need to learn. But before we get down to the nitty-gritty of the podcast, I do want to say that obviously derivatives trading is not suitable for all investors. Past performance is obviously not indicative of future results, and anything that we are discussing here tonight is purely going to be from an educational perspective. So adopt whatever you find useful, reject whatever you find useless, and add your own unique twist to it. But none of this is investment advice. So I think without further ado, welcome, Kris. Thanks for joining me again.
Yeah, man. Thank you so much for having me. I really appreciate it. Our conversations are always pretty deep. So, I'm glad to be here and open this up.
Yeah, me too, man. I mean, it's like one of the things that I've always liked about you is not just your ability as a trader. And I've said this to a few people whom I've spoken to. I've recently been getting into speaking at corporate events, like doing presentations and all that stuff. And I use volatility and risk and a lot of Taleb's kind of analogies, like the green lumber fallacy and all that stuff, to explain to people how we as humans often just see what we want to see. We don't necessarily see what's really there. So that's a really, really key aspect of what I look at. But what I've always liked about you a lot more is your humility as a person. Like who you are has always impressed me a lot more than what you do. And I think we also found a very strong connection as people in terms of the fact that we also do jiu-jitsu. Now, jiu-jitsu, as people who know me know, has really changed my life a hell of a lot. And in fact, I would actually say it's made me a better trader, funny enough, given that I learned how to, how should I say, grapple with not only the markets, but also with myself. Given that you do jiu-jitsu, have you found that it's made you better in any way as a trader?
Yeah, I think it's one of those very few sports that really changed the way how I looked at markets, and I tell this to guys that train as well, and they just don't see it, right? Because they're just not far into trading as we are. But the psychological implications that jiu-jitsu has on an individual's trading is big, because the first thing, it's going to humble you, right? Like, I can't tell you how many times where, like when I first got started with jiu-jitsu, I'd say I'm in like year 6 or 7 now. Right, when I first got started with jiu-jitsu, I was athletic in terms of, I could bench, I lift weights, I could deadlift, squat. Like I was fairly active in the gym, and I was boxing before jiu-jitsu, so I had some sort of fighting experience. So then I get into the gym, and like here I am fighting a guy who's like 130 pounds, and he is dismantling me. Like literally I'm at this guy's mercy for, every 30 seconds he's tapping me out. And it humbles you in a way, because you say to yourself, like, wow, like what I thought I knew, like I really don't know. And I think it creates this thing in your head where you're saying to yourself, like, I can be so sure on something and be wrong, right? I can have massive confidence in something, right, and just be completely wrong. And I think that's something that markets do too, right? And you'll notice with like the good traders, they have that ability to accept that. They have that ability to say, like, okay, I'm wrong on a trade, and I'm not going to average down on a loser, and like I'm not going to sit here and fight the market and go against this. Like I could accept the fact that I'm wrong, and I'm willing to live, to trade or fight another day. Whereas and I'm sure you've seen it in trading, and training as well, guys will get hurt because they're very stubborn to tap, right? So like you'll be training with a guy and his ego will be through the roof, right? And you have him in something like, let's say like a heel hook, right? Like something as a heel hook, I mean, that could tore your meniscus, ACL, all that could go out in a matter
of, I tore a guy's ankle accidentally by doing that. He just wouldn't tap, and I had him, and exactly as you said there, he was a blue belt. I was a very, very new white belt at that time, and I had him in sort of a hook, and he just kept pushing up, and I just said tap, otherwise you go, and he didn't tap, whoop, tore his ankle.
Yeah. So I think that, like, what's the point in that, right? Like, what's the point? Like, now you can't train for 6 months, right? Now you're out. Like, it doesn't make sense to me. And the same thing is trading too, right? Why go completely all in and martingale this one position where you're saying, you're like, oh yeah, I have to be right on this. And if you believe that there's this like non-ergodic component of the market where it's like, the time series ensemble is going to be very different, you're eventually going to run into one of those events where you're wrong, right? And you'll eventually run into a guy who's going to be able to submit you and break your arm, right? And if you're stubborn and fighting against that in a different way, like I think that it could hurt your life, hurt your trading, right? So it's one of those things where I think it humbles you tremendously. The jiu-jitsu side of things made me very disciplined in a lot of different ways that obviously applied to trading, and it humbles you in a way to be understanding that I'm going to be wrong about a lot of things, and I'm okay to be wrong about that, and I'm okay to be submissive to the market, right? Because at the end of the day, that's what jiu-jitsu is, right? It's the gentle art, and it's the art of flow, right? So I'm going to let an individual create a move on me, and I'm going to be reactive of that move and not sit there and be stubborn and aggressive and fight through it. So I think there's a lot of lessons to be learned through that.
Yeah, totally. I mean, just bringing that up, it literally just reminded me of volatility in a market, for instance. So a slow moving, or what's the correct term to use? A low volatility market. I sometimes call it a slow moving market, or a low volatility market. That's sort of like when you do a flow drill and nothing hectic is taking place between you and your opponent. But a high volatility market is when you turn up the heat, and and then you see what someone's really made of, and then you see what you're also really made of. Sorry about that, guys. You'll see that there's a bit of a dip in the actual podcast. My Zoom bailed on me. Got a lot of technology at times. But I think what I was saying to Kris is that I've noticed that, markets can be like people too. So for instance, you might do flow drills and, you feel that you can hold your own against higher belts. For example, let's say you're a white belt or a blue belt and you go and do flow drills with brown and black belts, and they kind of take it easy on you. They let you get a few taps here and there and vice versa. And you don't let them tap you, they'll tap you in any case. But the markets are very similar to that. And I think it's very important to also know what you can handle, but more importantly, what you cannot handle. What are your thoughts on that, Kris, regarding that analogy?
Yeah, I think it's one of those things where, again, like you don't know what you don't know until you're faced with that actual adversity, right? So like, when I was starting out too, or even when I started to get good enough to roll with guys who were like black belts, it was at that point where I was just like, I think I have some sort of advantage of them, right? And I get caught in a trap. And I think with younger traders, you see that too, where the volatility could be very juicy and appealing for a lot of people because they're like, this is what we're waiting for, we could make money, active trading, and things are volatile. And then you get caught in that situation and then you're like, oh man, I actually can't handle this, right? Because the sample points for those are very small. The same way, how many guys are actually black belts that walk around out there, right? It's like
2,000.
Right. So, think about that in comparison to the entire world. right? And oftentimes you always have that guy who's like mega tough, right, with his friends or his family. And, you know, he's the guy who lifts a bunch of weights and, you know, he's Mr. Tough Guy. And he comes up to the gym and like some guy who's just like a regular, you know, probably 6-month white belt just crushes this dude because he's never been trained fighting before, right? He's never been in that type of situation. So everybody swears they can fight until, you know, you run into somebody who could actually fight. And it's the same thing with markets, right? Like very small sample points until, you know, you run into that event that you're like, oh, you know, I can't wait until things get this way, you know. It's the very famous thing too, right? It's like everybody always talks about wanting to buy the dip until it's time to actually buy the dip, right? Like, you know, like nobody has the courage at that point in time because it's a different environment, right? So psychologically, it's one of those things that, you know, or some people will jump in and they'll do that and they won't know how to handle it, right? They'll oversize, they'll maybe undersize, they'll chase, it's like, you know, their mentality, their trading discipline is not there because they haven't walked that path before, right? So it's just one of those examples that go hand in hand with the two.
Yeah, totally. And I mean, I've seen this time and time again. And trust me, I don't speak as someone who proclaims to do the right things all the time, because I do a lot of the wrong things still. You know, I just minimize the number of times that I do the wrong things. Well, hopefully I do. But I've noticed with volatility, for instance, is that you think that you've got a good beat on it until it really turns up the heat. I mean, it's just one of those things where I don't think anyone can ever fully control it. You know, you can sort of like ride the wave as well as you possibly can, but timing it 100% is incredibly difficult to do. It's just one of those things that I don't think you'll ever get it right all the time. No way.
Yeah, I think, you know, that's one thing about volatility that I love as an asset class is that as much as specifically, you know, the tails, specifically like kurtosis and skew trading, right? Because as mathematical as it is, it's the one area of trading that is like unquantifiable, right? You can't quantify, you know, something that is naturally kurtosis because it wouldn't be kurtosis if you could quantify it, right? And then when you think about like a dynamical system that's always changing, it's like one of those very few things where the participants need to react in real time and adapt in real time, right? So like vol is one of those like weird asset classes where the sample points and the data become less and less and less relevant in the times where you need it to be super relevant, right? Like in the times where you're like, I need to be very dependent on this data, like becomes less reliable. And the inherent view that you can structure something that pays off 100 to 1 or has some sort of convex or asymmetric payout, that's super appealing too, right? Because now you're telling me that, well, I could take a bet on the fact that somebody is underestimating the full potential distribution of outcomes. And if they're wrong, right, because that's what standard option pricing is, right? It's human sentiment basically saying like, we're betting that this event is not going to occur, right? Like based on backward looking historical data, right? People are trying to forward project what's going to happen based on backward looking historical data and something that is, you know, non-finite. So it's just like, if you're going to put a cap on this and you don't really know the full distribution of outcomes, right? Because think about it, as humans, this is what we're seeing, right? We're only seeing here and here, right? So all we're seeing is these points, like here and here, right, from past outcomes. But who knows if this is going to be the time where the data point goes like this, right, or goes like this, right? When you're thinking about some sort of Brownian motion, or you know, I don't want to convolute this with, you know, all this.
Yeah, it's like the convexity and the concavity, you know.
Correct. Right. And that becomes appealing because that's what trading is making smart asymmetrical bets on things that humans underestimate. And, you know, you may be wrong a lot of times, but, you know, when you're correct, you get paid out in a very big way.
Yeah, I'll never forget that bet that you guys took on, what was it, Salesforce. last year sometime, and I think it netted you something like 471x, if I recall, if I recall correctly. You know, you bought it at something like 7 cents per contract, and you sold it 33, or it went to 33. That was ridiculous. I just remember that from a Bloomberg article that I read last year sometime.
Yeah, the Salesforce thing was again, you know, it's one of those things where you hoard something, you know, on your books. I think the way how we trade is very different, right? Like I don't want to sway people into thinking like, you know, go out and buy one delta options,
no,
right?
definitely not.
Right, like definitely do not do that. You know, like that's if you are a trader who is trying to survive off of income, those type of strategies really are not like the optimal strategy. It's always good to have things that are convex by nature in your, you know, your portfolio, but you don't want to be YOLOing way out the money calls and puts, right? But for what we do, it's a certain type of mandate, it's a certain type of, you know, opportunistic vol fund that we have for our investors, and certain things like that become appealing at certain points in time, right? So it wasn't that we knew Salesforce was going to, you know, go, you know, tremendous on earnings or anything like that, right? It was not that at all. Like we couldn't tell you what it was going to do on earnings, but based on where it was and based on our assumption, you know, we kind of had this forward forecast. Okay, this could happen if this happens, and that could happen. And we kind of just, you know, got lucky, right? Just like we missed on, you know, hundreds of those before, right? But this one, when it pays off in, you know, a tremendous way, where you have something that goes from 7 cents, and then, you know, I think the options were priced at like $36 or something like that. You know, obviously, and we monetized in tiers, right? It's not like we sold directly at 33. We took some here, we took some here, we took some there, you know.
No, but you see, Kris, this is exactly one of the things that we spoke about before we went live now, and it's what I said to you about that quote from that book called The Alchemist, where the protagonist asked the alchemist, why did some alchemists never learn how to turn lead into gold? Because essentially they were only interested in the gold and not living out the destiny. I mean, I've not fully seen you in action and stuff, but I've been reading your tweets for a while, and, you know, gaining information and learning from what you've been saying and stuff. And I mean, you've got a freaking tweet pinned on your profile that says live, breathe, and eat, live, breathe, and sleep trading. This is like the NBA for me, you know. And I think this is what people don't really get about what it actually takes to become a trader, because being a trader is not all fun and games. Far from it. I mean, there are periods that are so boring. I've had the last few days, you know, after this big run up that we've had in the market, where we've had a balanced market, and there's nothing that I can really do at the moment according to my strategies that work for me. But what am I meant to do? You know, chase things? No, I have to wait. And I suppose it's very similar for you guys too. You know, you can't just rush into anything at any given point in time. You have to put a lot of work into this to get to the level where you are.
Yeah, so, you know, one thing I will say is, you know, what we do is very different from like the spectrum that I want to like speak on, right? So like from what we do is more so, you know, we're catering to, you know, allocators, family offices, institutions, you know, high net worth individuals who are looking to hedge off their book and are looking at some sort of opportunistic vol that pays out in a very big way if markets fall, right? So we have our own different way of trading, right? And we have our strategies that we run and things of that sort. But there's another form of trading that is the background that I come from, right? The old school prop style, the way that, you know, you trade to generate alpha to survive, right? So like two different forms of trading there, right? Like you could take some and apply it to here, which is what we do, which I think is what makes us special, is because we have that, you know, prop trading background, flow trading background, that understanding of markets and dislocations and generating alpha within staying within our mandate. But then here's the other side, right? And this is the side like I really want to talk on, is just because I know most of the listeners are probably, you know, trading to create alpha for themselves, right? Or for their family, or, you know, like strictly absolute return. I eat what I kill, right? And that's the background that we come from. And it's a difference. So like, you know, going forward in the interview, I'll definitely speak more on that side. And what I will say is, you know, you're 100% right, because there are times where you need to be able to understand that you can't pull the trigger here because the opportunity doesn't set up, right? So you may go through these long periods where you're just like, you're bored out your mind because, you have to sit on your hands because the opportunity doesn't present itself, right? And you want to do certain things that are like outside of the process, right? Outside of what you do, because you're just like, okay, I'm up on the year. I want to have a little bit of fun. And then next thing you know, you look at your P&L, over the long run, you go back and you check into those quote unquote, like, spray trades. That's what, we like to call them, because you're just spraying. You're just like, yeah, it's a little bit of risk here, a little bit of risk there, right? Like those things add up, right? And then you look and you see, wow, I was up, 72% this year, but I gave back 15% on these dumb spray trades because I was just like, yeah, put a little risk here, put a little risk there, right? But when you're process driven, and exactly what you were saying, right, is like you're sticking to the process and you're falling in love with the process of being a trader and understanding that there's times where I got to sit on my hands. There's times where I have to be more risk focused. There's times where I have to up the size, right? These are like there's all these small little nodes that go into trading, right? It's like it doesn't just, it's not as simple as have a strategy, make money, right? You could have a great strategy and give it to a bad trader and he will not make money, right? And even a quantitative one too, right? Let's talk about like the quantitative side, because people think like, okay, you create some algo and you run the algo. Like at the end of the day, it boils down to human discretion, because the human side of it has to understand when the dislocation in the market has changed, when the environment has changed, right? And it's up to you as the human to understand the environment has changed, the regime has changed. I need to adjust that. And if you're not a trader and you don't understand what you're seeing, you can't make that change for the algo to work efficiently, right? And like the whole machine learning thing and AI thing is a whole different story, right? Like I've seen guys, put a lot of money behind those type of things, and I'll tell you, like they don't work as advertised. That's all I will say, right? So I think we're at this point where we understand that. And large allocators are understanding this too, right? Is the sweet equilibrium is the discretionary side mixed with the quantitative side, and that's where you get this trading. But you need to have the discretionary side, and that comes from the process, right? Being able to go through the process every day and be, an alpha generator and quote unquote like a killer, because you got to eat what you kill, right? Totally. And it comes with these little small details that you go throughout the day, where you're like, here's my process. I'm waking up, I'm doing my process. Some of the best traders that I've seen on the prop side were guys that would walk in, and this is going to sound crazy, guys that would walk in 10 minutes before the opening bell, because no matter what was going on, they knew their process and they knew what they had to do. And those guys were sometimes out of the office by like 1 o'clock, because it's just, right? All the rest is noise. They know what they're looking for. They know their process, they understand their process, they know their risk, and they're going to go in and they're going to do that. And if it's not there, that's it, right? Like I'm leaving for the day. My setup, my opportunity, my trade, my system, my process, that's it. That's all I'm focused on. I don't care if Apple's going, 2,000% up, based on something. I don't care if Tesla's falling because of, some SEC investigation. I'm sticking within my boundaries. And that's when you become good as a trader, right? Is following your process, like developing the process, following the process, of falling in love with that. And then it becomes easy at that point.
I'm really glad you said that, because coming from someone like you who's highly believable in this field, it does stick, I think, and it definitely does hit home, because, you are emphasizing the point that sticking to a process is essentially, if you're really thinking about it, going through the motions. It's like going for a workout, going for a roll or something. Not every workout is going to deliver a stellar performance. Not every roll is going to just lead to tap after tap after tap, but it's going through these motions that eventually help you to raise your average. And this is what I've said, this is what I do when I do performance coaching too, is I tell people, clients and so on and so forth, or just people that I help in general, because I also do this, when I mentor I help people to mentor new up and coming people in different industries. And I just say to them, you got to remember one thing, you are your average. So your goal is to raise the quality of your average, not worry about your peaks or your dips. And I think the same applies to trading. And I would like to hear your thoughts, whether you agree with that process or not.
Yeah, absolutely. I think you said something right there that it kind of opened up like another field, and hopefully I don't stray off, too
No.
much.
Remember, this is our session.
Yeah, this is one of those things where I think it's like, yes, you are your average, but I think the little details that you take within life, right? Like the little other small little details, it helps build this like discipline. And I know to some people, right, who's maybe listening on this conversation, they're probably like, oh man, here we go with the, hippie mumbo jumbo, like the Zen type of like, yoga thing. But the truth is right, when you implement these small disciplines in your life, it translates and it creates you into this like more holistic being. And I think that applies to you psychologically, right? There was one thing that like one old trader always used to tell me too, and like I embody it to this day, is you'd be like, dress good, feel good, trade good. Because psychologically, there's a difference. And I know there's some guys, listen, I know some guys that trade in sweats and crush it and kill it, right? And I'm not saying that there's anything, anything like that, but maybe your psychological, balance is there, right? Maybe you got up in the morning, you showered, you feel fresh, you feel refreshed, right? Whatever way that it takes for you to be in that like Zen, feeling good about yourself, feeling confident, I think that's what it is, right? It's not about the actual dressing, but it's about, do I feel in my equilibrium balance? Do I feel confident today? Is my headspace clear, right? And these little processes and details that you do throughout the day, right? Whether it's something as simple as, I'm going to follow a routine that and I'm, a little bit crazy with some of these things, right? But as soon as I wake up, right, I'll drink like, a cup of egg whites, right? I take my shower, brush my teeth, go to the gym. That's my routine. I feel clear, right? That's my discipline. When I don't do that, I feel like I'm sort of out of line a little bit, right? Like I didn't follow my process, and I try to stick to that routine, right? Every things that I do is more meticulous, and I think it solidifies this like psychological discipline that I have. So when I sit in front of screens, I feel clear and I feel understanding as to here's my process, right? Could be a little bit robotic in a way, but I feel like that's what brings me at Zen, right? To be the little bit better than the average of who I view myself as.
Oh, no, totally. And I think this is exactly what you conveyed it a lot better than I did, because I actually wanted to get exactly that across. Where you do these things to improve the value of your average, because you'll often revert to your average, but you want to keep on increasing the value of your average as you keep going up and up and up. And it's just amazing to see how many different factors come into trading. As you said, it's not only the markets that you have to deal with, but it's also yourself. You yourself, you're probably going to be one of the biggest obstacles to your own success in this game.
Yeah, absolutely. And I think in trading, right, you're trading against somebody else, and it is a competitive market, but at the end of the day, the first barrier to that is yourself, right? Because you have to be the one that clicks the buttons, right? Or programs the algos and lets the algos go, right? So at the end of the day, it is a game against yourself. Like you are fighting against yourself in a way, because you could sit there, right, and not partake in the game. Like you choose to partake in the game, right? So the first barrier is yourself. So once you're able to get over that step, now you have to go fight the rest of the interactive agents out there, right? Which is the other competitors in the market. So if you're not overthrew yourself, then here we go with you have to get past yourself, which is the psychological hurdles that we were just talking about, because it does apply. Because if you're on tilt, and it's the same way as poker too, right? Trading is to be looked at as poker, right? Like if you're on tilt, you're going to make very bad decisions. Whether it's you're looking at something and you're like, okay, and I'm just using this for example, this is not a real trading strategy or something like that, right? But let's say you're somebody that believes in, mean reverting trading, and you're just looking at the sample set and you're like, this is now went, 1.5 standard deviation, or let's say 2 standard deviations away outside of the realm. Now it's went back 1.5 to 1 standard deviation, and you're saying to yourself, oh man, I missed my shot to take that mean reverting trade, right? Now you're going to chase. Now you're going to take a bad trade because you're just like, it was outside of the realm of your signal, but now you're on tilt because you lost money previously and you want to make that money back, so you're making bad decisions. And I think a lot of people don't understand the importance of that, because when you look at a P&L, like a P&L curve, right, in a profile, like you don't factor in how much these little small details impact that curve, right? Where it's like, I chased today, right? So I lost, 1% today, but I chased, 3 days ago, and then I chased 3 months ago. And the next thing you know, that 1% that you lost all those times turns
It's
into
almost like compound interest in a way, except negative interest.
Correct. Right. So that's why it's important that you have to be on your game at all times. That's why, trading firms, I don't know, people watch that show Billions, and there's that famous thing about, the trader coach, the psychologist or whatnot. But stuff like that exists. People hire performance coaches because things like that work, because it brings you in line more psychologically to be able to make these decisions that are bounded by yourself before you're able to go compete and against the other side.
No, totally. I think you do need to be battle ready, if you want to have a hope of succeeding in the market, let alone guarantees, because we always know that there are no guarantees of success in this game. It's like what you alluded to earlier, that everything can be, the stars can be aligned, but the trade may not work out.
Yeah, absolutely. And that's the other thing too, right? And by no means am I the best trader in the world, right? Like, no way, shape, or form, right? Like, I have my flaws trading too. And like, I've been through my processes as a younger trader, right? I've walked the path and, experienced losses as a younger trader, but I've developed and I've grown into what I believe is a good trader today, using these rules and these applications. And there are some times where, as a trader, you're running a strategy and you have to be okay with the strategy going in drawdown. This eats at a lot of people, and they're not comfortable with this, especially when they're used to being winners, right? A lot of people who are type A individuals will gravitate over towards this game. And, what happens initially is, you do well in the game, you hear about this beginner's luck, and then, you think you're smart, you know it all, and then you start losing money, and then, you try to get that back and you make bad decisions, and then you just snowball this into this big, huge blow up. Because
I had that happen to me.
Everybody goes through this form. And it becomes hard because when you're down and you're getting kicked and everybody's pounding on you and you're like, this makes no sense. It's even worse because now you're saying, I'm going to go and I'm going to put in the work, right? So now you're saying to yourself, I'm going to go and I'm going to put in the work. I'm going to study extra hard. I'm going to stay in the office later. I'm going to do, more quantitative analysis towards, my process. I'm going to finite this. And then you apply it and then it still doesn't work. Then you're still losing money, right? And this is the difference, right? Because this is the difference in trading as to anything else. Because if I go in the boxing gym and I train for 3 hours for 5 days straight, my boxing skills are going to increase.
Oh, yeah.
But if I'm sitting there and I'm putting in the extra work and I'm doing all this trading, there is no guarantee that it's going to lead to net profits. There's no guarantee. In the long run, if you follow the process that has been laid out, right, and you follow the statistical proof, the process behind it, right, and the entirety of it, in the long run, it may work out. But in that small time frame, right, which is this 2-month drawdown period, it's eating at you. And psychologically, that could be that, big draw on people that I think not a lot of people are okay with handling, because we're so used to, as a society, when you do good, you're rewarded, right? Like capitalistic society, when you do good, you're rewarded, right? You work hard, you're rewarded. But that's just not how this game works, right? So sometimes you have to have things lining up in your favor, right? But over the long run, if you follow the processes and things, right, you can get there. But in the small little frame where it feels like every second is long, right, and every single, tick that's going up on the screen matters so much, it becomes something that is just very, very difficult to toggle with. And I think that's why most traders, kind of get cycled out. That's why a lot of people can't, stomach the game, because you have to be okay psychologically to say, been here before or done that, right? It's almost like a boxer getting punched, right? Like you need to
weathering a storm.
Exactly, weathering a storm. And it's like, man, you're a boxer, you're gonna get hit no matter what. You're a trader, you are going to lose money. So sorry to tell you, I don't care if you're Jim Simons, I don't care who you are. You will lose money no matter what.
Well, I'm a big fan of a guy called Ray Dalio. For anyone who's not familiar with him, Ray Dalio has got the largest hedge fund. I think he still has the largest hedge fund in the world, by assets under management, if I recall correctly. Bridgewater is their name. And I mean, last year during the pandemic, his all-weather fund lost 20%. So that's a big chunk of money to lose for a hedge fund. And they created the all-weather fund to make money, as they said, under all circumstances. And well, it didn't. This case in point, as you just said.
Yeah. And I think, right, it's one of those things where bad decisions just leads to more bad decisions unless you're experienced.
And right? I'm not hedging on them, by the way. I'm a big fan of Bridgewater and all that. So I'm not beating on them, by the way. I'm just saying that even guys their size could have mishaps. Disclaimer.
Yeah, absolutely. Everybody, right? I think, there's when I first got into trading, I learned under Bob Cantor. Bob was one of the old guys that started the CBOE, and he was one of the presidents of the CBOE Market Makers Association, right? And he was a really good trader. He ended up starting this big firm, sold it for a lot of money in the late 90s. And the thing about Bob was that he had this mentality as a gunslinger in a way, right? Where he would trade, he would generate alpha, but there would be times where Bob would lose money, right? And what would seem to most people like, oh my God, Bob's going to get carted off on this, right? To him this was the game of trading. Now, listen, I'm not saying take these very large P&L swings, right? I'm actually super against that. I am more in the side of you should be in a structured and more sort of safe profile as to how your P&L curve looks. But to be able to stomach that at times, right? It comes with a part of the game. It's like, again, as a boxer, you have to be able to know what it's like to be in the corner getting walloped on, and you're seeing stars and come back and win that fight. And it's the process, right? As a basketball team, you're going to be down sometimes in the fourth quarter. You're going to be down at halftime. You're going to be down. It's the same thing, right? So it's the process, and you have to go through this. And psychologically, you have to be okay with that. You have to be okay with handling the drawdowns times, because you have to be able to forward forecast and look and say, I trust the data. I trust the process. I do not see any change in the regime of the environment, and I'm going to stick to that. And if that's the case, then long run it will play out. And the confidence comes from managing your risk too, right? And your sizing and all those things. But I think that's one of the biggest things is people being able to stomach, the full distribution of what could happen and what eventually will happen.
Oh, totally, Kris. But I mean, you just alluded to something really, really key over here, and it's the size management. I could be wrong, but I'm of the belief that many traders lose money, and I'm saying this because this is how I've lost a lot of money, by taking on too much size too soon. And the reality is that leverage always seems like a wonderful idea when it's working in your favor, but it's super easy to forget that it can also count against you. So it maximizes your profits, but it also maximizes your losses. And I use an analogy that I like to use for leverage, and I'd like you to build onto this. If you feel that there's more to add to it, is that leverage is almost like going to gym and adding weights, like adding weight plates. So let's say you're doing a squat and you're doing, I don't know, you can lift I'm guessing you can lift about 400 pounds, maybe a bit more. And you start squatting, yeah.
No, no, not me. No, no, no. I
Oh,
squat
okay.
365.
Okay.
I squat 365 for what it's worth, guys.
Okay, let's use a deadlift. A deadlift, a 400-pound deadlift is a very respectable deadlift. Especially, I mean, I weigh about 175, I think, roughly speaking. So for us, your weight, I'm guessing, is also roughly in that kind of area.
Yeah.
So 170, a 400-pound deadlift would be very respectable, for us to go and lift. So let's say that's your one, maybe 2 repetition max. And all of a sudden you start adding 20 pounds onto that, or 25 pounds, because you want to get to that 200 kg mark. And you just go and you lift that thing as hard as you possibly can, and you tear a muscle in your back, or you tear your hamstrings and all that. Okay, you're out. What the heck do you do now? So you thought that you were going to compound your strength by adding that extra weight, but you just literally wrecked yourself altogether by taking on too much too soon.
Yeah, that's a very good way to put it. You definitely need to ease into that. I am of the belief, and I'll give you guys a real example, right? We have a strategy that is somewhat flow based, right? So it goes back to thinking about the old prop style, that's absolute return. How can I generate alpha? And in doing so, I'm sure people have read the old trader saying, right? You don't average down on losers, and you add to your winners. You compound your winners. I believe in certain little small heuristics like that, and because of that, I believe in the mathematical implications of fractional Kelly sizing. That's something which inherently, right, removing any of the math, it's pretty simple, right? The probability of things are working in your favor, you size more to that. That's pretty much the principle of it, right? Probability in your favor, you size a little bit more additionally, right? With some sort of fractional approach, right? You're not risking the entirety of your bet size or your portfolio, right? So that is something that I'm of the pure belief in, is when things are working in your favor, add a little bit more, right? You're trading flow throughout the day, position size going against you, right? Going in your favor, add a little bit more, right? You don't want to average on losers, but you compound your winners. And I think it's one of those things where it's a process that avoids being forced into saying, I need to use leverage and I need to use it all at once. So when people think about using leverage, and when they think about trading, right, it's a simple approach. You could scale into positions, right? You don't need to take the one shot. And then when it comes down to the whole leverage thing, the first part of a trade, right, and again, I want to make sure everybody understands, right? We're talking absolute return, eat what you kill style, right? Not volatility, optimistic volatility mandate or something of the sort, right? We're talking eat what you kill. When it comes down to a trade and you're putting on the trade, the first thing you're supposed to know is, what is the risk? Where at what point am I wrong, right? So, and one thing I used to do as a junior that helped tremendously was I used to write this down, right? So I used to write down where and why am I wrong? And it could be something as simple, right? Again, if you're trading flow, you could be like, okay, I'm wrong if this gets under VWAP, right? Because I understand there's a big institutional order that's getting filled all day on VWAP. And if this gets under VWAP, somewhere post 12 o'clock, I understand that this guy's gone. Something super simple. So you understand, okay, this is where, or let's not use VWAP because that number could change. But let's say there's some guy bidding SPY 450, right? Some guy that's SPY 450, and you say, okay, I understand that there's an institutional order SPY 450, right? And if it gets under, I'm wrong. That's what I'm writing, right? So now I have a specific point where I could say I'm wrong. I have a reason why I'm wrong. And now I could size to that, right? So how do I size to that? Now you have to look at your account and you have to say, how much of my AUM am I willing to risk on this one trade? And I am of the belief, even in eat what you kill, right? I don't like risking, right, in that eat what you kill style, anything more, even on my best days, than 2% of the account, right? So and prop, other guys who are prop style will be even lower than that. And most of the time I was lower than that too, right? But I'm thinking more in terms of a smaller account. Realistically, would like to be somewhere along the, 0.5%, maybe, you know, you're really hot on it, you know, percent or something like that. But then, you know, there's other people who will have this different distribution, and, you know, that's okay. But putting, you know, 20% of your account at risk on one trade, that's foolish. I will never, ever, ever co-sign anybody doing that, no matter what account size, right? And that's the thing too, is that you have to remove that mentality where you're thinking about things based on the account size, right? Like, unless you're running $100 million plus book where, you know, liquidity could be a problem. But, you know, if you're a smaller size account, you know, 1 million, 2 million, something like that, you know, like, you have to almost look at this in some sort of like a game process where you're not looking at the P&L, because the P&L is going to disrupt your decision making, right? So you have to just be thinking somewhat in percentage terms, where you're saying, how much am I willing to risk on this trade, right? If I'm wrong, and then you take the trade, right? Then you put on the position, right? Because you know, if this goes under here, I'm not going to be punching walls or punching through my monitor, or, you know, getting upset, knocking things over, totally. Right? I'm okay with it. I'm cool. I'm calm, collected. Like, I'm wrong. Damn, I'm wrong. You know, I lost on the trade. All right, that's it. You know, next one. Let me see what else is, you know, out there in terms of my process and my system, right? Not the other way where you're just like, I'm going in on this, right? And then I'm going to figure out where I want to size. And oh man, you know, it's going against me. What do I do now? Like, you have to have a plan, right? And that's, again, it goes back to full circle what we were talking about before, right? At the beginning, when we talk about preparation and going through our process in the morning, right? Drinking the egg whites and going to the gym, right? Because you're detailed in that, right? So things that you do are routine driven. So when you go to put on risk with actual real dollars, it should be routine driven, where, you know, hold on, why am I getting in this trade? Where am I wrong? How much am I losing if I'm wrong? What is the reason why I'm going to be wrong, right? And then going through with that whole process and following through with it, right? And that's where I think most people get it wrong, is they take the other approach where I'm just getting in on the trade and things start going wrong, and then they start rationalizing, right? That's the worst, is when, oh, okay, I'm only down, you know, $30,000.
Naive rationalism, yeah.
Right. Like, I want to find hope, right? Some guy on Twitter is talking about, oh, you know, this could potentially happen, and now I'm start looking at metrics that don't even matter. I'm looking and I'm praying, oh, wait, this is now, you know, at the 20 RSI, and like, no, that is what that will do. It puts you in a fetal position looking for hope. And when you're looking for hope, you're going to start looking at all these things and start saying, that's the reason why I should be in this trade. Meanwhile, your P&L is showing you, I'm down. My account is getting wrecked. Like, I'm hurt. I should be out of this. But because of the hope inside of you, you're looking and you're begging for something to give you a reason why you should be in the trade. And then the trade will turn around, and then you'll be like, okay, it's going in my favor, right? It's going in my favor. Okay, you'll be cool. And then it goes against you even harder, right? And
I
then
had
it's
that
just
happen
like,
to me 2 weeks
right.
ago.
Everybody has same everywhere, right? Because we've been through these processes. But this is why it's so important to understand, right?
And you're so right, Kris. And you know what's the worst feeling ever is if the market gives you a chance to get out, you know, either at break even or a profit, and you almost say, no, I want more. And the market really goes, is it? And then just whacks you down again. That is the worst feeling ever. And sometimes, and this is still a hard lesson for me to learn at times, is that if you are wrong and the market gives you an opportunity to get out at a small profit, just take the damn profit at times, you know, because the chance of you being wrong again, you know, maybe the next day or the day afterwards, are so freaking high because you were wrong in the first place. Sometimes you get a dead cat bounce, you know, either on the short side or the long side that goes in your favor. Just get out if you know that you are wrong. And yeah, sometimes I still make that mistake.
100%, man, 100%. And I think where people go wrong too is, right, they're super they're not understanding about like assessing the current environment and the flow and the price action, which I understand could be completely different for other people's strategies and things of that sort, right? But it doesn't, like, I don't need to get knocked out at my stop to be wrong, right? Like, I could understand, and again, right, thinking about flow trading and things of that sort, I could understand that, this is not, even though I said I'm getting out for this reason, right, and this is where my stop is, something is wrong, right? And if you sit at front of screens every single day, you do this every single day, right? And you watch this and you'll know, right? You'll know something's wrong. Like, it's just, that's the internal side, right? There's the subconscious side, the quote unquote gut feeling that we have, right? Where something is wrong here. Like, I should be either, if not getting out the position, maybe I should trim my size a little bit, right? Because now the distribution of the trade has changed, right? Where it's like, what I expected to happen is no longer happening. So if you're in the moment at that time and it's not happening, now it becomes a coin toss, right? Two different things, because at the beginning you thought this was going to happen because XYZ.
Yeah.
Cool. Price action is moving, right? But it's not confirming your thesis. So now, if it's not confirming your thesis, literally a coin toss, right? So then what do? Are you going to keep the same sizing that you had when you came in the trade? If you quote unquote had this as, an A setup where this was a great trade based on XYZ, because breaking it down, flow trading, so people could have an idea. If I had a premise that, okay, I know at, 9 a.m., this one fund is gonna, or let's say 9 a.m., let's say at 12 p.m. Eastern time, this one fund is gonna come in and they're gonna be buying this name to fill their mandate. I know this is gonna actually be running because of this constant bid, because of a market maker that has to fill this order, right? Cool. That's my premise. If 1 p.m. comes and that thing is going down, and I'm looking at it, I'm like, damn, nobody's there. Like, nobody's soaking any orders. Nothing's getting bid. Like, the order book looks very weak. Like, I don't need for it to, go through lower day and, slam in my face and I lose money for me to be wrong. I could understand that. My premise is wrong. Maybe they pulled the order. Maybe they canceled the order. Maybe something like that, right? So that's super important when you're going through this form of trading, is like being able to say, it's not only about a stop, right? But my assessment as to what's going on will prove if I'm wrong or right.
Yeah, totally. And conditions change so quickly in any case. I mean, we can have a news event that comes out and an economic figure. Like, I was watching the flow earlier in the S&P 500. Geez, there was de-risking at a massive rate into the close, as you saw, guys just getting out big time in anticipation of tomorrow's figure. So tomorrow's figure might be a lot better than expected. And then it's, hey, risk on, carry on as normal. But right now, we don't know. So this is what happens. And it was actually quite amazing, because I use this program called Bookmap, this one running here in the background. And you can actually see a heat map of the entire order book. And good heavens, Kris, I mean, you see algos putting on orders, pulling them. Last week sometime there was a player that came in and literally put on, I kid you not, 3,200 S&P contracts, somewhere like what I'm just trying to remember the time, was about 5:30 my time, so 10:30 Eastern time. All of a sudden the market just ran up once those 3,300 or 200 contracts were on, and they never moved. It was only very late in the day that someone pulled those orders again. So exactly, it proves your point, that things just change all the time, and you've got to adapt to it.
Yeah, for sure. Last week was a very very interesting week. One of those weird weeks too, and it's one of those things where things could be abnormal, and it goes back to what we were saying earlier in the conversation as well too, right? It's like, there's going to be some environments that you're fit to trade in and some environments that you're not, right? It's like, you get to pick, and that's the beautiful part about the game, is you get to choose when you want to sit down at the poker table, right? Nobody's forcing you to be at the poker table. Like, you could take your chips and leave anytime. I think, right, it's one of those things that a lot of people have to understand, like, but they get sucked into the fact that they want to be part of, like, the sex appeal of, I'm going to trade CPI numbers tomorrow. I'm going to trade Tesla earnings. I'm going to trade, when the market is getting smoked, I want to go in and try to buy vol. You never bought vol before. You don't understand how vol is priced. You don't understand, like, the implications of vol. You don't understand what sector you're buying vol on. Like, you don't, right? But at that time, this is what's blasting on CNBC. This is what's blasting on Bloomberg. This is what's here and there. And as traders, right, it's a sex appeal. Like, oh, now you became a vol trader, right? Like you never traded vol before, but because everybody's saying like the market's going down, it's like now you became a vol trader. All right, out of thin air, you just became a vol trader, and you go and you step outside of the realm of what you do, which you could have been a guy. And again, this may sound super crazy to some people, but there are some people who generate tons of profits by doing very simple strategies that are long focused, right? Like, especially on the prop side, you got a lot of guys that run strategies like this. You may have been crushing it, but today is the day you decide you're going to break the process, break the system because you want to be a ball trader. Instead of saying, you know what, let me, 6 months ago, I want to go through data when this occurs, what happens to this location here and that. What could I expect this to be priced at? Can I forward forecast this? Can I understand the product? None of that. You didn't go through any of the process, but now you want to jump in and be a ball trader. And that's what harms performance, right? That's why guys give back stuff, because they deviate away from the process. So I think that's one of those things that's really key, right? Is being able to know when to sit down at the poker table and when to not be at the poker table. And sometimes literally just sitting on your hands saying, it's not my game, I'll gladly watch because, it could be entertaining. And that happened to me quite frequently as a younger trader too. And I made a lot of these mistakes, right? This is the only reason why I'm able to speak on them, because I made these mistakes quite often as a younger trader where I would be doing very well. And next thing you know, I go in there and I'm deviating outside of the stuff that I do. And, maybe I'm up, 30% on the year. And I look back at the numbers and I'm just like, wow, I really gave back, 10% because on the year, because of 30 trades that were just outside of what I do. When you think in terms of large numbers, right? Because everybody wants to get to that, whether trading large numbers, that's big. That's a huge difference. That 10, 20% difference, it matters tremendously.
Oh, totally. But once again, I think it also, as you mentioned about the whole thing where you do well and then you feel a lot smarter. I think that's called the Dunning Kruger effect, if I recall correctly, where you start overestimating your own intelligence relative to where you actually are. But that aside, something that I still find, and I'm a lot better with this nowadays, but I find that euphoria and despair are still equally as addictive as what they were, at the beginning of my trading career versus where I am now. I just handle it a lot better, but those two emotions are ridiculously addictive, especially euphoria. You see a market just moving up, and as you said, oh, I want to be part of the action, the sex appeal. I just want to chase this now. I want to be in on it. Because as Howard Marks, I don't know if you've read any of his books, but I'm busy with one called Mastering the Market Cycle. And he said, nothing is more painful to a person than watching other people make money or more money than them. And that is essentially one of the things that leads to chasing. And I fully concur with you on the fact that sometimes sitting on your hands is the hardest thing to do, because you know that if I chase this, I'm probably going to be the unlucky sod who gets in at the top, and then I'm going to get nailed all the way back down. And yeah, sorry, go.
No. You're 100% right.
I thought you were going to say something there, but that's just something that has also occurred to me, is that nowadays I'm focused on making money. And I know I'm talking about myself here, but I can only really speak for myself, because I would like you to build onto anything that I say, is that I'm obviously focused on making money. There's no question about that. But I'm more focused on not losing money. That to me, I found has been a far better approach to being profitable, is to avoid these situations where I know I'm likely to lose money. For instance, it's like when I'm rolling with someone in jiu-jitsu. If I know that a triangle setup doesn't work against this opponent, I'm not going to try a damn triangle setup against them, because I know that they know how to defend against it. So I'll look for any other weaknesses that I could exploit, but I'm not going to try a setup that I'm good at but doesn't work against them.
Yeah, I think this brings up a very interesting point too, is to where you're looking to generate your alpha. And this is something that I see with like some of the young kids that will reach out to myself and, some of the other ball traders on Twitter, like, Ben, Chris Cole, Jem, like all the rest of the ball guys is, there'll be a lot of kids that will want to be in this space and they want to learn ball trading and all that's great. And you should, right? You should during your time at college, you should spend time, learning and embracing and soaking in as much as you can, because you don't know where you'll be. You could be, a CDX trader, you could be, a vol trader, you could be, a macro trader, like, you don't know, right? So you should soak in as much as you possibly can. But sometimes there are kids that reach out to me, right? And they kind of think that they have a good idea as to what's going on. And I'm never dismissive towards any of that, because we've all been young and exuberant, and, we all had that mentality that, we're smart and we're, we could do things. But a part of me sometimes says to myself, well, man, you're competing against a lot of smart other guys out there in a space where you don't have good information flow, right? The space where you don't know too much about how things are moving and why they're moving, right? And like the dislocations that come from it. Like, why participate in this? And, my partner and I joke about this, and, he says all the time too, like, you would be the guy that would go and, sit around in AC at 2 o'clock in the morning and then make money on the poker table while everybody's drunk. And it's like, why wouldn't you play in some of the easier games? Now, learning is different, right? You want to learn the complex stuff, right? You want to try to engage. But when you're thinking in terms of, generating alpha, like, why would I want to go in this field? Why would I want to fight Floyd Mayweather when I could, kick over, grandma's cane?
The odds of winning are so low, let's be honest.
Right. So it's like some of the things I think people scorn at, and, they kind of, step away from, because they're like, oh, there's no appeal in this. Man, like, on the prop side, I'll tell you 100%, there are a lot of things that prop firms to this day do that you would be shocked that they do, because they understand there are small little pockets of alpha that exist in these little areas, but nobody wants to touch them. And I know, Darren Johnson is a good friend of mine. Him and I talk about this quite frequently. It's like, there's a lot of alpha that's out there, but there's this like need for people to feel like they're involved in the most sexiest thing and the most, complex thing. And instead of just saying, I'd rather just go and pick up, I'd rather go pick up my dollars, because, the dollars are there and they're laid out, so there's pockets where there's alpha that's out there, and it's no alpha's easy alpha, but it's a hell of a lot easier than, trying to come in and arb this ball curve against, guys whose technology is tremendously faster than yours, like, or like guys who understand why the dislocation is there, so like at the end of the day, the end goal is to have more money today than the day before, right? And by all means to get there, right? Like, whatever it takes, whatever strategy, whatever area, whatever field that you could play in to get to that point in time, right? And I think that's something where a lot of people miss it, because they're just so, they want to be engaged in all these other things except for the area that's where the alpha lies.
So they don't want to pick up the low-hanging fruit. They want to get the fruit right at the top of the tree where most of the wind is blowing.
Yeah.
I think it's such a typical human nature thing to want to do that, though. It's almost like a bragging right, if I can call it that.
Yeah.
And what you said, it just makes so much sense, though. Why do you want to go for bragging rights if you can have money in your pocket? I think money in your pocket pays your bills. Bragging rights mean nothing at the end of the day.
For sure. And again, I think when you're thinking about trading in this absolute return form, right, and generating alpha, and more so eating what you kill, that's the mentality that you have to have, where you're just like, I'm going to sit there and I'm going to do what works, and even if it may not be sexy, or, it may not be appealing, or it may not be super complex. And I know a lot of guys, gravitate over towards us because, like, we're like the vol guys or whatnot, right? And things that we're doing is, mathematically based, right? Like positional imbalances based on, some sort of Bayesian inference, right? It all sounds cool and all this stuff, right? But like the complexity doesn't mean that it's better than, doing something super simple, right? Like there are some super simple things out there that work. And, I speak to people who have been very successful in this business, and it's the same joke that just gets passed around on the inside, that you would be surprised as to how the simplest things are the most alpha generating things. Like, and these are people at big shops, right? You complex shops that you would think that, oh my God, they're running like, 50 different factors against, this regression, that regression, and this sort of, forward forecasting model, and, this Garch model. And it's none of that. It's just something super simple. And I think a lot of people, because when you're thinking about retail trading, right, and, more so the smaller accounts, they're looking at the outside, right, or even the smaller prop accounts, and they're like, man, I wonder what the institutional guys are doing. Like, I wish, I could be doing this, and this, right? And it's just like, there's so much money in the lane that you're in, you don't even need to worry about participating in that other lane, because when you do participate, you're going to lose some of that money, right? And it impacts your trading decisions, it impacts your P&L, it impacts everything, right? So again, this conversation is going to keep going back into process, right? Like at the beginning, we spoke about process, right? And it just shows, like, when you deviate away outside of the process, and there is no reason to deviate outside of the process, right? Other than gambling. And if you're going to gamble, might as well go to a casino, have a little bit, have a little bit better odds of some of the things, instead of, gambling on an area that, you know nothing about.
Yeah, that's very true, my friend, because I think a lot of new traders especially don't realize this, but trading is like poker, as you mentioned earlier. It's a very predatory game. And I don't know if you watched this movie, what's the one with Matt Damon? The name of the movie has evaded me. John Malkovich and Matt Damon were in that movie. Help me out here, my friend. Come on, what's it?
It's gonna suck, because I'm gonna take heat if people look at this, because that's a movie that I love. Like, that's a movie that I love too, and I'm missing the name off the top of my head too. I always love to pay that man his money. Right, pay that man his money.
It's man, this is going to bug me, and I know it will come back to me later.
I'm gonna have to take the L and literally look this up.
Because look it up, please. But there was this line that Matt Damon's character said, that if you're sitting at a poker table and within the first half an hour you cannot spot the sucker, then you are the sucker.
Right, it's Rounders. I'm sorry to everybody listening. This is embarrassing that I forgot the name. We both forgot the name. Yes, it's Rounders. Yeah. Yes, very famous.
Thank you.
Very famous poker movie in the 90s. Yes. Yeah. No, you're 100% right. Yeah, if you can't spot the sucker at the table, you are the sucker.
I think it's the same at the trading floor. Well, whether you're trading at home or on the trading floor or wherever, if you cannot spot the sucker, in the market, if you cannot spot the weaknesses, then you are the sucker. For the intent purposes.
There's a lot of like old CBOE stories about like guys in the pit who were like designated as the sucker. I wish I could tell some of them, but obviously I don't want to tell anybody's story and get anybody in trouble. But what it speaks on is that echoes on for quite a while, right? In terms of speculating, right? Not just poker, but in markets and everything, right? And when you think about like what markets boil down to, it literally boils down to simple supply and demand dynamics, right? So what a market game is, it could be as simple as you put 5 people in a room and give them a water bottle and close the door, and each have $1 in quarters or something like that, and tell them trade this. And a lot of trading firms have games like that sort, because it's true, it's supply and demand based, right? It's like, that's what trading is. Can I figure out something that is a dislocation based off supply and demand dynamics? And what it infers is that you have to have an understanding of the other participants and how they will react to certain environments and conditions, right? And that's where I think it becomes super interesting. That's where the whole game becomes interesting to us, right? So that's like one of our biggest things is, can we estimate how an asset will move based on how another participant is going to be engaging in that asset in a specific regime? That's literally our whole like business right there. And in terms of, you know, what we do is like, can we model that out? And then we understand the model won't be, you know, right. Like, you know, a lot of the models that people put out there, you know, half the time, more than half the time, they don't work, right? But that's the premise is, can you figure out how this is going to move based on that other interactive agent in the market doing something in a specific environment because of, you know, this other reason? And it's like this big chain event of things that occur, right? So like when you're thinking about, again, generating alpha, you have to be thinking about like other participants in that way, right? Like I'm sitting down at the poker table because I want to win this game. I want to take, and this sounds, you know, a little bit egregious, and, you know, I apologize if I'm coming off this way, but you want to take money from the other participants who are in the market, right?
Because it's not egregious. Right. If you're at that table, you're a willing participant, so you're willingly participating in the wins and the losses.
Correct, right? So that's why it's important to have that mentality too, where you know, you're spotting where those other people are going to make irrational decisions, you know, and you know, bad decisions. You know, one thing that a lot of people joke about is this whole buying the dip thing. And my partner and I joke about this a lot too, because, you know, his father was one of those guys that, like, he pounded the table when things were going bad, and he was just very like, yeah, buy more. And we had this rolling joke for years, like, yeah, you know, your dad's gonna, you know, your dad's gonna eat it on the chin, right? Your dad's gonna take it on the chin, like, you know, silly old man, like, you know, you don't know what you're doing. He knew what he was doing, right? He knew what he was doing in terms of, yeah, I'm buying, right? I'm stepping in and I'm buying, right? The buy the dip thing, even statistically, it works, right? Even if you could run a million quant models, right? You want to run some sort of Hurst function to see if the SPX is a trending time series, like, please go ahead and run it, right? Like, go ahead and go through any type of statistical inference that you want. It's going to lead back to US equities have a positive upward drift.
Absolutely.
Right. And, you know, it goes back to doing some of these things that are easy and make money. And I'm not telling anybody to go out and buy the dip, right? I'm definitely not saying that, but I'm giving an example as to, you know, like how he looked at things. And one of the reasons why simple things like that work is because of the premises that you're able to get in front of something when other participants don't want to take that trade. And that is a belief that I always have, that there's alpha. Like, I want to be taking the trades that other people don't want to take, because that's where the alpha is, right? So when the rest of the world is saying, you know what, I'm puking up Amazon down, you know, 35%, or, you know, whatever the case is, down 7% in a week or something like that. And again, I'm not telling anybody to buy the dip, right? I'm using like examples,
educational examples,
right? I'm gonna step in and I'm gonna buy that, right? Because when everybody's puking and irrational, and my partner and I were young traders throughout this process and seeing his father do this, and obviously, you know, we're joking, oh, silly old man, you're gonna pay, but that's what he was doing. He was taking advantage of another individual's fear and their overreaction and going in and doing something that worked over time. And that's why, you know, he compounded his wealth tremendously by doing something super simple like that. But if you remove it, right, you remove the belief and you put it into other buckets of strategies and areas of trading, there is alpha there. There's alpha in managing risk, and there's alpha in taking the trades that nobody wants to take, right? Like, you hear about, because markets are ecosystems, and people fail to understand that the positional imbalances from the ecosystems and the large swings from that is what creates alpha. That's why you heard about all the vol sellers blowing up over the years, because that was a one-sided trade, right? Everybody got on that trade, right? One-sided trade. Everybody's on that trade. When everybody overreacts and panics, there were some smart guys who were able to step in and sell vol at the right time because, right, and here's the difference, right? Here's the difference, because people have this bad misconception that selling vol is bad, yada, 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 right? Sell vol systematically, that's bad. When you sell vol in a more regimented way, right, in a strategic way, it could be a huge profit generator, right? Opportunistic short vol stuff can be huge profit generators if you're able to be very, very strict about, you know, how you're selling it, how you're managing risk and things of that sort. So there were guys that stepped in and got a chance to sell massive high vol and made money. But the guys who were just one-sided on that one position, right? Here came the ecosystem swing. They got wiped out, right? And then we swung back the other way, right? And then this is how strategies and markets work. It's an ecosystem where one side is going to control it for a little bit, right? And it boils down all the way down to like 30 seconds of flow trading, 1 minute worth of flow trading, right? Like ecosystems, the sellers control, or the buyers control the market. For this time, there's large buyers that are stepping in, right? And when everybody wants to buy and everybody's saying, oh man, this thing's going to the moon, boom, like they start selling it off, right? And then the sellers take control. Ecosystem switches. And I think that right there, when you think about things in that fashion, it could gauge your mentality a little bit better.
Do you remember a movie with Bradley Cooper called, do you remember this? Limitless.
Mississippi River?
Limitless.
Oh.
Did you ever watch where he takes that pill, NZT-1000, and he becomes the superhuman version of himself? And he became a trader, you know, in the movie itself. And during one of the scenes, he was talking to a group of people where he said that there are no hedges against human nature. We are literally designed to overreach. And he used examples in history. He said, for instance, take the Portuguese, for example. They didn't, instead of saying, hey, you know, we've got a nice couple of condos in Brazil and Mexico, well, in Brazil and back at home, they wanted to keep expanding their empire and they ended up losing a lot. And he said the same was what happened for Nazi Germany. You know, Hitler did exactly the same thing, as did every other great conqueror, Genghis Khan, the whole works. It's like we're almost hardwired to overreach. You know, it's the euphoria, it's the euphoric overreach and the despair overreach at the same thing. If this market goes down, oh no, it's going back to zero. And if it goes up, as you said, it's going to the moon. But we know that realistically it doesn't work that way.
Yeah, absolutely. And that's what's important too, is you know, by the way, my movie game is terrible. I think I said Mississippi River or something like that. Like,
well, that's another
Mississippi grind. Like, I apologize. You guys are probably laughing at me. Hopefully you guys make fun of me for this on Twitter. My movie game is bad. But no, you know, that's really true. You know, and when you think about how asset prices move, right, and dislocations get created, it's based off of investor sentiment. Investor sentiment is driven off of human psychology, right? It's this flow chart: human psychology, investor sentiment, right? Price discovery or discrepancy, dislocation, alpha, right? Like that's how that flow chart process works. And humans inherently will do that. Yeah, they're gonna reach both ways, and there's a sign of like greed. That's why if you look at any bubble chart, and the reason why it's a bubble is because every bubble chart is the same, right? It's like, and I wish I could spin this around and show you guys, but I have like a thing of like tulip mania, like a little you know, picture of tulip mania in the office here, but it's all the same charts where it's like this, because at this point it's just euphoric action where everybody's just like, I went in, right? And it's hard to forecast when that's going to end, right? That's the other side. And a lot of people say, oh, we're in a bubble and blah, 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 right? That's a whole nother conversation that definitely don't even want to go into.
And it's not got to do with intelligence, by the way. I just want to add that in before you build onto it. Even the most intelligent people can get caught in bubbles, aka, correct. In other words, Isaac Newton with the South Sea bubble, he got caught at the top of it.
Correct. And I think what a lot of people are realizing today is, you know, you frequently see that meme where it's like, you know, the dumb guy on one side and the very intelligent guy on one side and the idiot, you know, right in the middle of the bell curve, where it's just like, you know, sometimes when things are so crazy, it's good to take, you know, go long that Six Sigma event instead of saying, yeah, it's going to mean revert back to normalcy or whatever. But the aspect of what is creating that dislocation comes from the fact as to this is how humans are going to think, right? They're going to, and markets will always be this way. That's the crazy thing about, and this is the thing that fascinates me so much about this game, is that, nothing has changed from the thousands of years ago when they were, trading, wood and carpets and things of that sort, to now. Now we're doing it in the same way. It's the same human psychology where you limit the actual supply and things are going to go up, right? Like you increase the demand, right? Like things of that sort. This is what moves markets, and it's all like psychologically driven from human sentiment, right? So those things that like euphoric type of buying, we will never not see that. We will never not see that. Because if you think about, you break this down into any little thing, like you could be traders of Batman toys, right? Like the next hot toy that's coming out for Christmas. People are going to drive the price of that toy up, for resale, like on eBay. eBay is a market. You could be a trader of Batman toys through eBay, right? Like this is what trading is. But people don't, like, they can't get that. Like they don't understand that, like, oh, that's a form of trading too, right? Like, I'm not saying go and trade Batman toys, right? What I'm saying is that the same way how you think about everybody's rushing in to get that Batman toy for their kids. So if I get, 50 of them, I could resell them on eBay for, 3x the amount or something like that. That's what trading is. It's the same thing. Now it's applied to companies and derivatives on the companies and things of that sort. So when you focus on what the driver of that's going to be, what's going to drive these people to want those Batman toys, like it's going to drive, right? The human euphoria that comes behind that. That's where you're able to figure out what could potentially happen next and how could I make money of what's going to happen next.
No, totally. And something that I've also noticed with trading and the whole process of making money, it's exactly as you said earlier, that when you make money, you feel very smart, and when you lose money, you feel very stupid. So what's the one thing that people don't want to feel? Stupid. So if you watch other people making money, let's use crypto. And once again, as Kris always says, no one's advocating anyone's buying anything. But I learned a very interesting distinction the other day between crypto markets and, say, trading the S&P 500. That the S&P 500 would be considered what's known as a steady state market, and crypto would be considered herd activity markets. And that there's actually a massive bloody difference between the two. Just because you trade well in a steady state market doesn't mean you'll do well in a herd activity market, or vice versa. Your entire mentality might be more suited towards one or the other, and you could actually find yourself getting busted up. Because I've often heard this argument that, it must be so easy trading the ES relative to crypto because we are used to 20% swings on the upside or the downside. And yet I can always guarantee you that if they come and trade something that has a 1 or 2% move, on a more frequent basis, they might actually get busted up. It's not so, sorry, go ahead.
No, dude, you're 100% right. I think, again, it goes back to what we were talking about, like in the conversation, where you have to understand the participants and how they react, right? So the same way how, you just identified, crypto could be a herd type of, group where maybe the, US equities may not react in that same sort of way. You've done first step of identifying the participants and how they'll be reacted to certain things, right? So like, that's like super important. And yeah, I agree. It brings up the next subject of actual, like, strategies fitting certain people, right? So certain asset classes won't be for them, certain styles of trading won't be for them. And all those things, I think you smooth out over time, right? As you get good, you can start and pick and choose, okay, this fits me a little bit better. I'm not comfortable with these type of swings in terms of doing what things I like. I think you should always be strategy hunting and always be thinking creatively, like, but you don't want to deviate too much outside of, what is, comfortable for you in the process that you've developed.
Oh no, definitely not. And I mean, I've also learned the hard way that just because you can trade, as you said, one asset class doesn't mean you'll necessarily trade well in a different asset class. I mean, I've been looking at crypto, nothing serious, just some small positions here and there, but it's a totally different ballgame, literally so different compared to what I'm used to. And I know wholeheartedly that if I were to go and just say, well, let's go balls to the wall and just throw caution to the wind, I'd probably lose all my money in less than a month, if I were to just go and do that. Because something that I've noticed with volatility is that it's always so damn appealing when you, as I said, when you see people making money, when you hear of these stories or read of these stories on Twitter where these guys claim that they made, say, 1,000x in a year or 10,000x or whatever it might be. I do ask myself this question: how many of them are there? How many guys lost 10,000x, relative to the ones who actually made 10,000x? Because if that were the case, then surely all people trading crypto would, if it was so easy to make money from, say, an asset class like crypto, because it's the new big thing, surely there must be a hell of a lot of losers too in the game, not just all these winners we read about.
Yeah, absolutely. I think what's important in this market that distinguishes it from others is the dissemination of news and the dissemination of information. Because what you're seeing now is look, some guy could be on Twitter and he could talk about making money on crypto or something like that. He could have 100,000 followers, and that could influence 1 million people. There are sometimes where I have tweets where I'll go back on the tweet that has 400,000 impressions. I'm just like, wow, 400,000 impressions, right? How many people skim through this? And I'm not really a big account, right? I think I have 30,000 followers. Relative to finance stuff, I guess maybe that's a big account. But there are other people out there who have huge accounts, especially in the crypto space, right? So you have this thing that makes it different than the other environments, because in the 80s and the 90s, you don't have one guy that's somewhat swaying the viewpoint of other people that easily, right? Think about how if somebody's seeing, oh man, he made 20x, 30x, right? Maybe that's impacting their rationality to now go and swing for the fences because of this. But I think you're right. I think there is this echo chamber as well on social media where people only talk about winners, right? Everybody's a great trader and everybody only makes a ton of money. I guarantee you that's not the case, right? And good traders will admit, that. And sometimes what you see on Twitter too is people will just shy away from their losses, right? And that's, as a person, I think that's when I lose, I actually want to be the first one to stand up, be like, yep, called it wrong, head down, I'm eating that. I don't want to be the guy that's my tail between my legs walking away, because as a person internally, I feel like a little bit of a coward. I want to be yeah, I acknowledge I messed up, I lost, but again, that's part of the game, right? Because everybody's going to get hit, everybody's going to lose. But we have this belief, or social media has led some of these younger traders to believe that, oh, guys don't lose money, right? These guys, all they do is just print money. Nobody prints money. It's not easy, and nobody just makes a ton of money. But the social media effect, it spreads this stuff, spreads it all around, where everybody's millionaires, and they talk about everybody who's 19 buying crypto has made a ton of money, right? But how many 19-year-olds not made money? I see memes and stuff all the time about kids breaking their desks and things of that sort because they're upset because they lost money. So the game doesn't work that way, and it's important for some of the younger traders to understand that and don't have their expectations at that. Don't have your expectations that you're going to come in here and be tremendously rich, because it creates bad trading habits. It creates, if this is what you want to do, maybe you don't want to do this, maybe you just want to gamble, which, more power to you, sure, take the Hail Mary toss up, but be able to stomach the results, so for sure.
What kind of personality type, or rather types, have you found to be the ones who, and I don't want to say, always become successful, because that's, too much of a blanket statement. But I guess what I'm trying to ask is, have you picked up on any specific personality traits or types who generally do well in this game?
Me personally, I would say that I've seen the same type of individual in people. Like, it takes a certain type of individual, and I'll see glimpses of that individual the more and more that I get to know good traders. Like, it's like he's quirky, weird, he does weird things. Like, I could relate to the reasoning for that. Like, so I see these like certain little blocks of their life, and it all boils down to some of the things we were talking about at the beginning too, right? The discipline, super rigorous in the process, super like meticulous. Those are just some of the staples that good traders really have. So you have this like, I don't want to say cookie cutter, because anybody could transition themselves into that. But you notice the successful guys have this cookie cutter approach where they're always hungry to learn more, right? Always hungry to learn more, always hungry for information, always, process driven, always meticulous in the stuff that they do. And the number one thing, number one thing, it's going to upset a lot of people, but the number one thing that makes a trader really great, that I've seen like some of the best traders, and this may not be the lifestyle that some people, want to go down, is the selfishness. Every good trader is tremendously selfish.
I was going to say obsessed, because I find myself being obsessed at times. Well, would you classify that as characteristic too?
Obsessed is it, but your selfishness is going to pull away that leads into that, or the obsession sometimes feeds into that as well. But like, every trader is selfish because they won't break standards, right? They won't break things for other people's standards, right? So if they know that, I gotta be here at this time, because earnings are coming out, like, doesn't matter if, parties going on, doesn't matter if there's, Christmas time, doesn't matter. It's just like, I want to be here because I'm obsessed, but I'm going to be selfish because, I'm going to be selfish to my family. I'm going to be selfish. And I'm sorry, some people may disagree with this, that's fine. Everybody has their opinion. But from what I've seen from like, the high alpha generating guys, maybe not, oh, I'm always going to, kick my family to the curb or something like that. But there are times where it's just like, I got to put this aside. Like, I got to be, I have to focus on this. And because I want to focus on this, right? So like, I don't want to go out with the boys tonight. I don't want to do this. Like, or sorry, I'm not going out to dinner. I'm missing this, missing that, because I'm so, you're right, obsessed, right, with my art. But in a way, I'm selfish because I'm not letting anything else get in the way of my obsession. Like, nothing else gets in the way. Right? Like, that's like a hunger thing, and like,
it's a ruthless selfishness. Exactly that.
Yeah. And I think, you often hear times too of guys who are traders being divorced and things of that sort. Now, look, I'm sure there are, hundreds of good traders that are out there who have families and, have loving wives and, manage this correctly in a good way. But I know for a fact that for that individual to get there, he had to be selfish in some capacity. Had to.
But doesn't this exactly tie into what we spoke about earlier about living out the destiny to get the gold? Because this is exactly that, where I know that some people would use a different word, but destiny just sounds kind of right though, because this is the path you choose to walk down, as a trader, and it's not a freaking easy path. As you said, you have to be selfish. There's a level of obsession to it. There's an element of ruthlessness even in between those two, where you have to say, oh, sorry, we're not going out to the party. I'm not joining you guys. I need to be here for this. And these are the not so fun parts of living out the life as a trader that I think many people don't realize.
Yeah, I only have a small handful of friends, which I consider my actual like brothers, because we grew up. I knew them since I was 5 years old. We showered together. Grew up together, right? Like
family.
Yeah, these are as close to as brothers can be, and these are the only individuals in my life. And I find myself spending less and less and less time with them. But we always try to carve out a little bit of time throughout the week to go get something to eat, maybe just BS a little bit, watch a game or something like that. But there is no way, and I love them tremendously, that they could take me away from me being in the office at a certain time or a certain day. And I understand I have a responsibility to my investors and, to the business and all that. But there's nothing else I'd rather do, than like be here. Like I want to be here. There was something somebody showed me a little while ago. I think it was a tweet I had. It was either like Christmas Eve or New Year's or something like that last year, and I tweeted something about a back test. I was just like messing with some stuff because I had a thesis about something else, and I just like, oh, let me just run like a few like nonsense back tests. And somebody was like, what are you doing at, I can't remember if it was Christmas Eve or New Year's, or, they were like, it's a holiday time. What are you doing? I didn't even think about it in those terms, right? Like, I wasn't even like, oh, it's a holiday. Like, sheesh, I should take it easy or something like that, because it wasn't that. Like, it was like, I just wanted to be there. I wanted to be there because I had a thought that accumulated before, right? And it's like, I want to be there participating, doing that. Like, it's almost like if you tell a person who is madly obsessed with something, right? Like imagine, rest in peace, Kobe Bryant, but Kobe Bryant was a very obsessive,
perfect example.
Very obsessive basketball player, right? Very obsessive and amazing at his craft and what he did, right? But if you tell a person with that mentality, like, hey, I know, you bring in a shooting coach, and obviously Kobe had shooting coaches throughout the years. I know a way that you could increase your field goal percentage by 10%. It's Kobe Bryant. He's going to be he's not even going to care as to what's going on. He's going to be like, let's go to the gym. Like, let's go to the gym. How do I have to hold the ball? What do I have to do? Like, what hand motion do I have to do? How do I have to look at the rim? Like, where's my feet placement? What's my shoulder placement? He's going to say, that could be done. I need to be at it immediately. And I think that's the way how, as traders, like, if we have this selfish obsession, that's the way we think too, because we're always creatively thinking, right? We're always creatively thinking. Like, some of my best thoughts comes in these like moments, like where I'm driving or, I'm taking a shower and things of this sort. And immediately it's like, oh, I gotta go look into that tomorrow. Like, I gotta go check that.
I know what you mean.
I gotta go check that sample set tomorrow. I gotta go look into that. And like, I start writing it down in my iPhone notes and stuff like that. And then like, I'm super excited. Like, I get up, joke, drink my egg whites, go to the gym, and, immediately I'm in the office and I'm excited to be there because I'm like, hey, I want to test this today. I want to see. And I'll probably be, a lot of times you're wrong, right? You go to the test and you say, oh man, I'm wrong. But there's nothing else that I would rather do than be there. And if somebody told me, hey man, would you like, and this is going to sound crazy to some people, right? Would you like to go to Paris for the weekend? Like, would you like to go to Paris for the weekend? Or, it's on me. I promise you, like, to drag me out of here to go do that, like, it would not be as much fun to me. And maybe because I'm not gonna lie, like, I'm a little bit of a stickler. I don't drink, I don't smoke. I'm not a guy that really goes out and parties, right? So maybe that's not really my interest, but this is like what I'm selfish about, right? So if one of my friends were like, yo, let's go to Paris, let's go to Miami, whatever, right? Like, I would look at the phone and be like, yeah, you're crazy for even asking me that. I'm not going to that. Like, so I think the selfishness is a trait that you see in a lot of good traders, like, quite often.
Yeah, it really makes sense to me. And I think trading is all, trading at a high level, and I'm not saying I'm at that particular level, you're at a far higher level in terms of the things you do and the things you look at and understand than what I personally do. But I have noticed that as I've slowly been climbing up the ranks, and I always say I run my own race. I'm not competing with anyone else in terms of how well they or may not be doing. I'm running my own damn race. And I think this is one of the things that has helped me, funny enough, is to not be overly comparative towards anyone else. But what I've found is that my mentality has become more like that of a professional athlete, where that obsession, that selfishness, that devotion to the art, where I would sit here 10 hours a day, 15 hours a day sometimes, and I would not complain about that at all. Where some people would go, oh, well, aren't you feeling this or that? I would say, no, I'm actually very happy to do this. I wouldn't do that. I say, well, exactly. But I would. You see that's the thing.
Yeah.
And the same goes for you too, Kris. You would do that. That is the difference.
Yeah, for sure. And I think that's what I guess it boils down to too, right? It's like, how much do you really love the game, right? Like, and there's a lot of people that's doing this for, a paycheck or a job. And then there's some people that, are doing this because they genuinely love it. Sometimes you were talking about this, I think before we got on the actual recording, but there's some people that are just like, they're in love with the lifestyle more than they are with the actual art in the game, and they will just never make it because they're in love with the idea, oh man, you don't gotta answer to anybody, or answer to a boss, or you don't have to, you make all this money, you could drive a Lamborghini and all this. Like, they're in love with that stuff, right? Like, they're in love with the idea of what the results, what the game could bring to you. But there's so many other games out there that could bring that same thing to you. Like, that's
easier, probably.
Way easier. You could go and start businesses out there, like, from scratch, that will bring you that wealth faster than trading. And nobody wants to talk about that. Nobody wants to talk about the fact business creation in a small niche area could make you wealthier than you would be as a trader. It could bring it faster to you as a trader, but nobody wants to talk about this, right? Because the fake traders and the BS traders will show you the Lamborghinis. They'll show you, I'm making money, I'm doing this, right? Like, because it's a facade. Nobody, I can't even tell. I know so many traders, and I know people joke about, like, all the Bloomberg chats and stuff that I have in the back. I cannot tell you one of them at the top firms, all the firms, all the banks, all the prop firms, all this, that own a Lamborghini. Like, nobody owns, like, nothing, like, right? It's just
almost a telltale sign of a scam as soon as you see a website.
Correct, right? Like, it just doesn't work that way. But people are just so, that's what they want. They want the money. They want, the cars. They want the idea, oh, I don't got to answer to anybody, and I have few money, and I don't need a boss and all that, right? But you're not going to make it because you're in this game for the wrong reason. Like, yes, like, money should be the driver. We all want to make money, right? That's why we're here. That's why we're playing the game. But there's another part of it, right? There's another driver behind this thing that's moving the entirety of it forward. There's another driver behind it. If you don't have that like hunger, that passion, that love, that exhilaration when you're playing this game, then you're not gonna, be a good trader, which is okay too, right? Right. And here's the thing too, right? There is nothing wrong with not being a good trader. Like, it's okay, because there are other areas in finance where you can make it. Investment banking, there's a slew of jobs in investment banking.
Financial advice.
Right. As people mistake quants and traders, right, all the time, because they feel that if you're a quant, you can automatically trade. A lot of the quants at banks, I would say 90-something% of them cannot trade. Tell you for a fact. Been there, done that.
I fully agree with you. And I've noticed that too. Many of them are so bloody smart and highly mathematically inclined, but they know nothing about how markets actually work.
Correct. Right. So I think it's like, it's this other piece, other component to it, that you need to have that driver behind you, or else, you're not going to make it. Like I said, you could be a million other things in this business. There are people who are CIOs, which is crazy to me, but there are people who are CIOs in the business who can't trade, legitimately can't trade, like cannot trade.
Me. I didn't know that.
Cannot trade. Allocators cannot trade. People who allocate money to other managers, and there are people who cannot trade, right? So it's not the end of the world if you don't have this, like, this drive, or this like passion for it, but it's a telling sign to give you some sort of insight to know, should I be pursuing this, or should I be doing this, and for what reason, right? Am I really exhilarated by the game? Which, again, it's going to be money driven, right? It will be money driven, like, because that's why we're all playing the game, to make money, but it's a different component of it, right? Like, it's not only just, the money, and it's not because of the Lamborghinis and, popping bottles at a club and the girls and stuff like that. I cannot tell you, I don't know anybody, any firm, even the bad firms, like, who engage in, things like that, go out, buy a Lamborghini.
I think that's movies. Movies have often created this impression. The Wolf of Wall Street and that other one, Margin Call. They create the impression that these traders are guys who just literally, I kid you not, and this sometimes really annoys me when people even think that I'm this way inclined. Oh, so you're someone who loves to sniff cocaine, right? How often I've been asked if I use cocaine. I've never even touched the stuff in my entire life, but I've literally been asked a number of times if I can get them some cocaine because I have a dealer. Suppose it's like ridiculous, or that I party with loads of different people and pop champagne the whole time. I barely even drink. Barely. Yeah. I don't smoke, but I barely drink. I lead a pretty healthy lifestyle for the most part. I'm not into that stuff.
And I know guys who are traders who drink, for sure, right? And guys who are traders who, don't live a healthy lifestyle, and they do well too, right? It's not that you got to be healthy and not drink and not smoke or something. I'm not saying any of that. But what I'm saying is, even in their own way, they are disciplined and process driven and meticulous about the certain things that they do. May not be with eating, right? May not be with eating, may not be with, the drinking or something like that, but they are process driven in the certain things that they do. And they may have those other areas, those staples of their life embodied in other areas that we may not see. But every trader is going to have those details in him and that process in him. So
yeah, no, I agree with you, Kris. And I mean, it's really great to hear this from you, because one of the things that I remember you said on one of your tweets a while ago was that if you really want to make it in this game, then you cannot purely rely on one approach. And you made it very categorically clear that you need to rely on your discretion and the quantitative side of things. However, whatever ratios you use, that obviously depends on you. But it's exactly it exactly boils down to this. You need to find the right approach that works for you, but you also need to realize that it's a multi-factor game. It's not a single factor game. Not by any means.
Yeah.
But sorry, go ahead, Kris.
No, absolutely. I think hopefully, I could be the poster child for this, because I'm so outspoken on Twitter about this, because I feel like, I've seen both sides fail. I've seen the pure discretionary side fail, and I've seen the pure quantitative side fail. And I, see the guys who use a mix of both do fairly well. Over the course of almost a decade now. This is when, I started trading. It's almost a decade now. I think, a couple months would actually make it a full decade, which is crazy to think. But this is the stuff that I picked up throughout this time, right? And I think the more sophisticated allocators and institutions are understanding this as well too, that everybody was so fascinated with the quant style, especially in like, 2012, 2015 and stuff like that. It was like ballooned, right? Everybody's like quant, like here's money, right? Same way how like people are looking at, some of the crypto stuff today, right? It's like, here's money, right? But then what they realize in like the quant stuff is like, damn, these quantitative approaches don't really work too well. And, the discretionary trader, the guy who's sitting there trying to buy breakouts, from, moving averages and things of that sort, from the 80s, that's not working too well for him either, right? He's sitting there, getting upset at screens and things of that sort because, it's not working out the way he wanted to. But when you bring the two together, right, and you have the data to support the dislocation, right, and the data to support the evidence as to what you're seeing, and you understand as a trader, hey, I see this, I understand how this works, I get it, I watch this every day, right? You develop that intuition and that process, you merge the two, and I think it creates this nice mix of something where you could generate profit.
No, totally.
That's just my belief. Yeah.
No, totally, I agree. And just to add a few final thoughts onto that, because as you were speaking, it just reminded me of how I would like to phrase this. It's almost like if you picture you're rolling with someone like Gregor, in your gym. I mean, Gregor's freaking beast of notes. Let's say Gregor is the market, for example, in this analogy. Knowing when to use certain, and you can do triangles, you can do Americanas, loads of different submissions. Knowing how to do them is the quantitative approach. Knowing when to use them is the discretionary approach. It doesn't help that you just know how to do the techniques, but not know when to apply them. That's pretty much what I'm getting across.
Yeah, for sure. I think the quantitative side will prove the dislocation, right? Can I statistically prove that this exists, right? And do I have supportive data? Do I have enough data? Can I use statistical proofs to say this exists because of this? And can I rationalize why it exists, right? And that's important too. You got to understand why are you able to generate alpha? If every day you're doing something and you don't know where it's coming from, you're blind, right? So you have to understand statistically, is there a dislocation here? Can I prove there's a dislocation? Can I statistically prove that this exists and this is happening? And when the data confirms that, and when you understand, because now you have to do the other part where you have to figure out, all right, where the hell is this coming from? Like, because you have to understand the participant, right? When you figure that out, then you put the two and two together. Now you say, okay, I have something I can make money on. Now it comes in to the actual trading strategy, the trading applications of the strategy, where I'm going to use my discretion as a trader. I see this guy, I know what he's doing. I manage my risk. I could up my size a little bit here, right? Those little tweaks are what makes the difference between 30% and 70%, right? The 70% returns or 30% returns is guys making those sort of tweaks. And then also, right, the assessment of the environment to say, this has changed, this is not reacting the way how it should be, and making those small calls along the way.
Yeah, it's quite an incredible process that we all have to go through, small adjustments, as you just said, small tweaks and adjustments. Kris, I mean, I think we could carry on talking all freaking day. It's like always such a pleasure to engage with you, and I always learn something new. Literally every single time we have an engagement, I just learn a lot from you, and it's just such a pleasure. You're just such a wealth of knowledge. I mean, your background is just ridiculous in terms of how much you've done in such a short space of time. So I just want to say congratulations to you for how well you've done, over the course of your career in such a short space of time.
Yeah, thank you so much, brother. That definitely is very humbling and means a lot to me. And I hope my my small story doesn't have anybody thinking this was like clear path. A lot of losses, a lot of learning experiences. Like lost a lot. Not a lot of money, but I've lost a lot, which to me back then was a lot of money. I I definitely, you know, earned my stripes in terms of, you know, the game and the process. You know, so hopefully, you know, nobody thinks that, you know, it's a straight path, because that's what trading is, right? Just like we're saying, you know, it's going through these processes and then getting better, and then, you know, collecting more data and getting better and improving and getting better until you know, you get to that point where, you know, and you're always improving. But yeah, the knowledge, I would say it came from the losses, right? You learn more about your losers than you do about your winners.
No, absolutely. Absolutely. And I think one of the things, as I alluded to right at the beginning before we got cut out, thanks to Zoom, was and I genuinely say this, you know, because I do consider you a friend without any question. Above all else, is that I've always been a lot, you know, from our chats and all that, and the way that you structure your tweets on Twitter and all that, I've always been a lot more impressed with who you are as a person than your ability as a trader. Because I always said that, you know, when it comes to having people in my life, I choose character above all else. You know how you conduct yourself in terms of decency and respect and all that is far more important to me than the occupation or the position you have in life. Far more, bar none.
Yeah, and the feelings are definitely mutual. Thank you so much for that, man. That definitely means a lot to me, because that's a big emphasis in my life. And like I said, you know, the feelings are definitely mutual, man. It's good to be developing friendships like this along the way.
No, likewise, my friend. Thank you so much for your time. I mean, I know you're a really busy guy. You know, just the fact that you would have this long conversation with me means a lot to me. And I know anyone watching this, and I think we definitely just need to run through this afterwards, see if there's anything that your compliance team might want me to edit out. But you know, I'm really, really grateful for the time that I could have with you. Yeah, really appreciate it, my friend.
Yeah, absolutely, dude. Absolutely.
So thanks a lot. And if you're trading tonight, have fun. I'm going to bed now. It's 20 to 2 on my side. Yeah,
it's pretty late.
Yes,
it's pretty late.
Yeah, it's pretty late on my side. But thanks a lot, Kris. I look forward to posting this, and I look forward to speaking with you again soon, my friend.
Yeah, absolutely, brother. It was a pleasure, man. We'll be in contact.
Perfect. Have a good one, my friend. Cheers.
You too, bro.
Bye-bye.